So when a company has no revenues, you're really looking at two things. One is if there's a product out in the market, you're looking at other metrics to work out whether that product is something that is going to become highly valuable. So number of users and growth is obviously really important, and then it keeps coming back to engagement. We really look hard under the hood at how people are using it, and there are now many tools and many techniques for measuring, particularly when you have web-based or mobile-based products, for measuring everything that the users are doing on those products. So a good startup can embed, fairly easily all these triggers, suck in all the information from what users are doing, and then the task is, how do you grab that information? How do you look at it and work out which parts of the product are working? What needs to change? How do you do things better? There's a lot of A/B testing happens. These startups do heaps of experiments on their web pages to look at conversion rates. It might be changing the buy button from green to red. It might be moving it to the left or right. It might be changing the picture. It might be changing the onboarding process, changing the order of it, or making you do something before you do something else. All of that stuff can be really A/B tested in a metrics way to see which has the highest conversion rates to success. So really jumping into those metrics. As we said, revenue is just one metric of this idea of product market fit, whether you're going to have a really valuable company. It's not always the best, so these metrics are more important. So we jump in and we spend a lot of time looking at that. And from that, we can really get a feel for whether the business is high quality, and coming down, and how close it is to getting to that stage of product market fit where we can feel really confident that here's something people really like, and we can start then to really push capital into it to try and grow it fast. Because before you have a product that people really love and you're confident that they love, it's crazy to spend time and money and effort trying to grow that product, because you're growing something that people don't like. They tend to try it once or twice and then forget about it. And that's where a lot of businesses have failed, in that they thought they've got this product market fit. They've raised a lot of capital. They've started to pour money into the growth of that product. It might be paid marketing. It might be time and effort marketing. It might be sales force, actual salespeople marketing and sales. But the problem is they're not actually keeping those customers, and they're not adding value to those customers, and therefore they're not building a business that's got longevity. Yeah, in most cases we're extrapolating out and we're thinking the revenues can be this, and it can get to this style of business and be this kind of valuation. And as you get obviously further down further along the growth trajectory, those valuations become clearer. And so we're kind of working backwards to that. There are also core industry benchmarks that kind of set where everyone's playing and what everyone expects for a valuation. The core thing that we say to founders is that each time you raise a round, you should expect to give up sort of 20 to 25% of your business. And it may be that for some really good businesses that comes down to kind of 15%, and it may be for some businesses that are finding it harder to raise that it gets up towards 30%. It's kind of that 20 to 25 is kind of standard. So that means if you're raising $1 million, it's kind of $4.5 million style of valuation for those early kind of seed businesses. Of course, whether it's a $2.5, $3 million valuation, or it's a 4.5, 5, and rarely goes higher than that. Just depends on who you are and what you've done and how much traction and how much of this product market fit you can show at the time you're raising. And that's kind of the seed round, that $1 million round. The Series A kind of valuations are $5 to $10 million. Again, as you get further up, the performance of companies diverges, so the valuation range diverges. But kind of $5 to $10 million valuation for kind of market cap or enterprise style value for the company is normal. And that's one of the reasons why when I see these crazy valuations, or really high valuations, I probably shouldn't say they're crazy, but really high valuations on the ASX, that it worries me a bit, because they are very out of sync with what the private markets have in the past and are continuing to invest on.